Hello, welcome to another weekly Taxes in Retirement Live. I am, wrong side, Andy Panko. Hold on. Nope, Taxes in Retirement. I am Andy Panko, owner of Tenon Financial. Thank you for joining me. We got a good one tonight. Tonight's topic is a question that, a comment / question / concern that many people have when entering retirement or considering retirement or already in retirement for that matter, is what to do with old employer retirement plans like a 401k, 403b, TSP or thrift savings plan, 457. I think that rounds it out. There may be a couple others I'm missing, and then small employment plans. I'll mention what those are briefly, but I just wanted to put that intro out there. I see comments are here. Hello, everybody. Thank you. Let me start with the dad jokes before I do the disclaimer. First, my wife told me to go and wash the car with my son. I told her I thought a sponge would be better. No, my son's not very absorbent. It's not going to work. Next, I accidentally rubbed ketchup in my eyes. Now I have hindsight. I don't know why Hunts even bothers. Like, am I wrong though? Seriously, when it comes to ketchup, there's Hunts. There's Heinz, and there's everything else. So like Hunts, I mean, yeah, it's red and it's sugary, but it's not Heinz. Might as well just go away. Let Heinz run the show when it comes to ketchup. And finally, did you hear about the horse that fell down a hill? He couldn't giddy up. Probably should have ended with the ketchup one. So that's the dad jokes. Thank you. Let me give you the disclaimer, which says this video is only general explanations and education. It is not specific tax, legal, investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor, which I am not. Again, I'm just some random guy here on Facebook talking about helpful hints in education in taxes and retirement. So thank you. So just to recap briefly, different people work in different industries and may not be familiar with the terminology behind all these things. But an employer retirement plan is simply when you work somewhere, the employer sets up a plan where you can contribute money, and that money's saved for the long term for your retirement. Generally, you can't take it out prior to a certain age, or if you do, there's a penalty to it, and things like that. The most common one, well, if you work for a private company, it's a 401k is what you're going to have. If you work for a public employer like a school district, most commonly it's a 403b. If you work in public government, like local municipal government, it could be a 457 as well. And then if you're a federal employee, there's the TSP or thrift savings plan. They're all sort of functionally the same. Typically, you can put money in on a pre-tax basis. You don't pay tax now, but then the money sits there, grows. You have to eventually pay tax when you take it out. That's called tax deferred. Many of those plans also have a Roth option where you can do the opposite. You can pay tax now, put money into an account that grows tax-free and comes out tax-free. That's a Roth. And then there's also for smaller employers, or even if you're self-employed, you can also open up plans. There's a special type of IRA called the SEP, S-E-P, stands for Small Employer Pension, I think. There's also a simple, S-I-M-P-E-L, stands for something, I don't remember what. You can open up a simple IRA or even a simple 401k, and you can even open up a solo 401k if you're self-employed, where you're the only employee and you have a 401k for yourself. So those are all employer retirement plans. There's larger differences for the large, actual big 1,000-person company 401k versus solo 401k, but the gist is the same, sponsored by an employer. So the question is inevitably, you've been working 20, 30, 40 years or more, you've been saving money in your 401k, 403b, TSP, what have you, and the time comes, you leave work, you retire work, it's like, okay, now what do I do with it? Can I leave it? Oftentimes you can. So the question is, well, what are the benefits to what's called doing a rollover, taking the money out of your employer plan and putting it into a corresponding IRA, individual retirement account, or a Roth IRA for that matter. So that's what we're going to discuss tonight. And like most things about financial planning and retirement planning, there's not a single best or right answer. A lot of this is dependent on you and your particular situation. In this case, your particular employer plan, retirement plan, how flexible they are or aren't, what investment options, what fees they have, things like that. oftentimes rolling it over does make the most sense, rolling it out of the employer plan. But there are times where you do want to leave it, even just potentially for a few years, and I'll explain what I mean by that, and then eventually roll it out. So without further ado, let me, and just as far as, yeah, here we go. Heinz is the only ketchup. Yes, I don't know what a Yinzer is, but I agree. Hans should just pretend like, stop pretending like it matters. It's so far in second, it's not even funny. So I'll gladly take questions. What I've been doing for the last few months is I'll run through my whole thing here with my slides, take whatever questions there are at the end, because otherwise when I tried to take questions in between, it just got, so sliced and diced and chopped up that it kind of broke the flow. So let me bring up my screen share. Got some slides, screen share. We'll do this. Yep. Share. Okay. All right. So you all can see this. So I'm going to do it as simple and straightforward as possible, just simply pros and cons of a rollover. And again, there isn't a right single answer. Oftentimes, again, rollover makes the most sense, but there are reasons why you wouldn't, or you wouldn't want to roll over all of it, for example. So let's start with the pros. The first pro of doing a rollover. So this is viewed from the perspective of, yes, you are rolling the money out from an employer plan to an IRA. What's good about that? And then what's bad about that? Now you can simply flip this, the pro of a rollover is it's the con of keeping it where it is. Did I say that right? Yeah. So anyway, I may just confuse things with that. But this is the pros of actually rolling it over. Let's start with more investment options. And this is, I want to say guaranteed because there's no guarantees in life, but I can say with near 100% certainty that regardless which employer plan you're in, you almost certainly have more investment options. At best you have the same amount. And the reason why I say that is if you're like self-employed and you have one of those self-employed IRAs, then yes, you have the near limitless investment options. But if you work for a large employer in your 401k or 403b, they usually only have a menu of funds or investment options, typically a few dozen. Some have more, some have less, but let's just call it a few dozen options. Maybe they're good, maybe they're not. Point is, you have near limitless options when you do a rollover to an IRA. IRAs, as far as the IRS is concerned, will let you invest in literally everything except insurance and collectibles. Those two are flat out barred. IRS will not allow it. Outside of that, you could, in theory, invest in absolutely anything. Now, practically speaking, you open an IRA at the main brokers or custodians, Fidelity, Schwab, TD, Vanguard, whatever. They're going to limit you to traditional financial investments: stocks, bonds, mutual funds, exchange traded funds, real estate investment trusts, and some other things. But basically, the typical investments, financial investments you're all aware of. You can invest in real estate and potentially even cryptocurrencies. Now, I don't know specifically which brokers or custodians allow that. That's kind of an emerging field. But if you want to invest in those non-traditional financial assets, you have to open what's called a self-directed IRA. And there are specialty brokers and custodians that do that. It's not going to be the Fidelities and Schwabs and Vanguards. It's going to be, the names are escaping me, but there's a handful I've come across in my travels. Some focus on real estate, some focus on letting you invest in hedge funds and other private investments. But point is, compared to a traditional 401k or 403b or TSP that has only a handful of investment options, you will have more options by rolling it out into a traditional, IRA or Roth IRA. So that right there, that's a big one. Now, there's a comment in the group the other day. Someone said that the current employer plan that he or his spouse was in, they were hesitant to leave because the returns have been so good over the last, whatever it was, 10 years. And that can very well be, and quite definitely could be the case. But it's not the plan that's so good or the plan's investment options. You can easily replicate whatever investments you have available to you in your employer plan. You can almost without doubt go get them somewhere else or something substantially identical, and probably for cheaper as well. So don't let the fact that your plan has had good returns so far hang you up from not rolling out because you're afraid you won't be able to replicate those. Now, yes, the past is guarantee future results or whatever that saying is. But it doesn't mean you can't get something that's almost functionally the exact same thing, outside of your employer plan. Now, there's one thing you may not be able to get access to. That's a con, and I'll say that for when we get to the cons. There's one investment choice that is kind of unique to employer plans that you may not be able to get in the outside world. Okay, what is this? I see these comments here, and this Yinzer is drawing my attention. Yunzer, like y'all from the South. How Yin's doing? Duquesne graduate. I guess is this like a Pittsburgh thing? I guess Hines. That would make sense. I know Duquesne's from out there. Okay. Anyway, so yes, I guess a Yinzer is someone from the Pittsburgh area. Good to know. Okay, let me go back to my slides here. So the next pro of doing rollover is lower fees. In almost every case, you can get lower fees by rolling it to an IRA. Now, you got to be careful with this. So as far as employer plans go, they cost money to administer. There's no way around it. And they should cost money because there's hundreds, if not thousands of employees, or someone that has to do the record keeping, the sending out of the statements, the issuing checks, the signing new employees up. That all costs money. So there's going to be administrative fees to 401ks. The fund options themselves may also not be the lowest cost funds. There could be cheaper alternatives out there that do the exact same thing or close to the exact same thing. And also in 403B plans, which are often in annuities, technically, not just traditional stock, bond, or mutual fund investments, there's going to be additional layers of fees in there because they're insurance products. And it's not a coincidence. The 403B market is dominated by insurance companies, and insurance companies they show up at a local school district, they make friends with the superintendent, convince him or her to, hey, let me come be the administrator of your whole district's plans. And then they pump it full of these oftentimes complicated, relatively high fee annuity products that in many cases aren't really the best option for the participants, for the employees, unfortunately. So in the case of 403Bs, fees definitely matter often more times than 401ks because 403Bs are many times stuffed with annuities. Now, the for what it's worth, a federal thrift savings plan, phenomenal plan, really simple, really, really low fees, not just the plan fees themselves, but the fund expenses are like 0.03, 0.04%, which are the lowest you'll find, across any other employer. But you can still easily replicate and get those exact same funds or close to it in the outside world by using some major fund providers have similar ETFs and broad market funds that have fees like that, if not zero. There are some funds that have zero ongoing expense ratios. So in that sense, the outside world is and could be cheaper than the thrift savings plan, which is kind of the benchmark of good, basic, low-cost plans. Now, not all IRAs are cheap. If you know what to pick and you go out and find, I'm not recommending one firm versus another, but like Vanguard has really low price funds. Fidelity has some really low price funds. So does Schwab. You can go and find really low cost funds to invest in. And the accounts themselves to open an IRA in almost all cases cost nothing to open, nothing to maintain, things like that. So if you know what you're looking for, you know how to pick the custodian, the account type, and the funds, you can almost certainly get lower fees in the outside world than you can by keeping your money in your employer retirement plan. Next, in almost all cases, you're going to have more withdrawal flexibility in an IRA than you will in your employer plan. Now, the employer plans can vary wildly. Every employer who sets up a 401k, for example, has discretion over what it will and won't allow. For example, when you retire, it can say you're only allowed one distribution, right? You can leave the money as long as you want, but if and when you take it, you got to take it all out in one shot. Because once you retire, they don't want to be operating like your bank. Because again, this all costs money and resources and time to administer these plans. They don't want you coming in, taking out $37 today, $100 the next week, $200 the next week. It's a lot of reporting and processing, whatever. So they may say, at one extreme, you can have one withdrawal after you leave, and it's got to be everything. Or they may limit you to once a quarter, once a month, handful of transactions a year, things like that. Or the transactions have to be of minimum size. It all depends on your plan. Whereas with an IRA, there's virtually no limits. Now, if you get carried away and try to take out, 20 cents 8 times a day, for 5 months on end or whatever, the broker's probably going to anger at you and tell you to go away. But generally speaking, I haven't seen a major custodian charge anyone or place restrictions on people for taking money out, either the amount or frequency of taking distributions. So in that sense, there's more flexibility to rolling your money out. More withdrawal flexibility, I should say, as opposed to keeping your plan in almost all cases. The other pro is simply less financial clutter. And there's a couple angles here. One is just simply less statements, less logins, right? Like who has a spreadsheet of all the accounts you have and all the usernames and passwords and whatever, which we all know we shouldn't do. We shouldn't put that on paper, but practically speaking, I'm sure a lot of people do. You're going to have a login. Maybe you have 3 different 401s, 2 from prior jobs, 1 from current job. There's 3 logins right there. Maybe you have 2 different bank accounts. Now you're at 5. Maybe you already have a brokerage account or 2, and you have an IRA. Maybe you inherited an IRA from someone. It's not uncommon to have like double-digit financial account logins for different things. When you stop working, there's really not a lot of need to have to keep the money in your old employer plan. So why not consolidate, roll it out, whatever? There's less logins, less statements. If you still get paper statements, less of those to worry about. If when you do start taking distributions, there's less different tax reporting you're going to get, because you'll just get one set of tax reporting from that one broker if you roll all stuff in there, as opposed to taking a little bit of money here, a little bit from this plan, a little bit from this 401. You're going to get 3 different 1099s at tax return time. It's going to make your tax return a little more complicated. So that's what I mean by less clutter. And also, I didn't say it here, but when you eventually pass on, whether it's your spouse or your children or a church or friends that you're leaving all of your earthly possessions and financial accounts to, it'll be a lot cleaner for whoever the executor or executrix is going to be of your estate to administer and pass on all your stuff if there's simply less accounts and less things to have to coordinate and wrangle and take account of. So it helps not just you while you're alive, but also when you're gone. It makes your estate administration a little cleaner. And another big one with less clutter is less required minimum distributions. So for any qualified account you have, IRA, 401k, 403b, TSP, when you hit 72 or the year you turn 72, you need to start taking money out. You can't let tax deferral last forever. The IRS requires you to start taking money out and paying tax on it at some point. As legislation stands now, it's the year you turn 72 is when you have to start. It used to be the year you turn 70 and a half. That changed beginning of 2020 to 72. If you have, let's say you have 3 401ks from 3 prior jobs and you have 1 IRA, you're going to need to take, when you turn the year you turn 72, you're going to have to take a minimum amount of distribution from all 4 accounts, 401k 1, 2, and 3, and your IRA. You can't commingle across employee retirement plans, and you can't commingle those with an IRA. So you have 4 RMDs you have to take. Kind of annoying. More chance that you're going to miss one of them, and you do not want to miss taking an RMD, because if you do, there's a 50% penalty. That's right, 50% penalty on the amount you were supposed to have taken but didn't. Now you can get that penalty waived if you can prove that, for whatever reason you forgot or didn't know, or I don't know, whatever. You can make a defensible argument why, oops, I know I didn't realize I should have or something. But, if you don't get that waiver, it's 50% penalty. If you have multiple IRAs, whether it's 1 or 10, you can commingle all those IRAs together for purposes of calculating your required minimum distribution. And you can take the RMD from just one of those multiple IRAs, and it'll be deemed to collectively satisfy the RMDs of all those IRAs. Again, you can't do that with employer plans. You have 3 401ks, you're going to have to take 3 RMDs, 1 from each, plus then your IRA RMD. So by rolling your employer plans into an IRA, all those other random straggler RMDs go away. You just have 1 IRA. It's going to be real easy, or much easier to not miss your RMD, to calculate what it has to be and things like that. The other thing is Roth IRAs do not have required minimum distributions because you already pay tax. The government's not going to force you to take it out and pay tax on it because you don't have to. But that's a Roth IRA. Roth 401ks and Roth 403b and Roth TSP do have RMDs. And that's where it diverges from IRAs. So even though you don't have to pay tax on the money when you take it out, if you have a Roth 401k, you do need to start taking money out in the year you turn 72. You can avoid that RMD by, again, rolling that into a Roth IRA. Now your 401ks disappear and go away, and you just have Roth IRA, traditional IRA. You're going to have to take RMD from your traditional IRA, but not your Roth IRA. Because again, Roth IRAs do not have RMDs. Roth employer plans do. It's annoying, doesn't make sense, but they do. So anyway, that's less financial clutter. Help simplify your life. And that's part of what I do with clients. And I think this really resonates with people. And any good planner / advisor should do the same. It's just make people's lives simpler, as simple as they can be, but no more simple than that. Don't make it so simple that you miss things, that you overlook value in the name of just trying to, get things streamlined. But there is inherent benefit and value in streamlining and making things simpler and easier to understand. So I'm a big advocate of that. And to the extent you're not otherwise damaging or missing something, make things as simple as you can. And this is all part of that. Next, I don't want to say this one's a stretch, but this one's kind of indirectly related. Better access to advisors. And what do I mean by that? So, oh man, I can talk an hour just on this. But if you have an employee retirement plan, like a 401k, you probably don't have access to an in-house advisor. Now, some companies do hook you up with that. Like if your plan's administered by Fidelity, your employer plan, there's a pretty good chance you may have access to Fidelity's their call center of advisors / planners, or whatever they call themselves, where you can call up, they'll give you some basic advice. They're not going to know the nitty gritty of your life and can't do a whole, in-depth plan for you necessarily, but nonetheless, you probably have some access to someone who can give you some basic guidance. But maybe you don't, especially for smaller employer plans. They're not going to pay for that benefit of you having access to some kind of advisor or guidance person. So you may be on your own. And if you want to work with an outside independent advisor, it's unfortunate, and I don't agree with this, but most of the advisory industry charges based on client asset size. Specifically, the vast majority of advisors cannot charge on money if it's in your 401k. There's no way to directly debit fees from that. There are some third-party services that are coming into the mix to help bridge that gap, but for the most part, 95+% of all advisors who charge and deduct fees from your assets are not able to charge from your 401. So if you leave it there, they're going to be like, I can't work with you, because you need to have money you can roll over into an IRA. Once in that IRA, I can then take my fee from it. Everybody's happy. I can bill you. We can now work together. So if you do want to work with an advisor and you don't have access through your employer plan, in almost every case, the advisor is probably going to say, hey, roll it out to an IRA. Now, I don't want to make this sound dirty, but to be frank, like I said, most advisors can't charge on money in your employer plan, so they're going to need you to roll it out in order for them to charge on it. Otherwise, they're not going to be able to work with you, right? It does sound sort of dirty when you say that, but that's just the reality of most of the industry. So if you do want to work with an advisor outside, chances are you're going to have to roll it out so he or she can then they oversee and manage the investments. That's one of the upsides, and they give you other guidance and advice. But they now have a vehicle by which to charge their fees, meaning they can deduct it straight out of your IRAs or Roth IRAs, whereas they cannot deduct from an employer plan. So it's kind of like I don't want to say it's a backhanded pro, because it sounds like, oh, why I'm rolling money out just so someone could take fees out of it. It's like, yes, that's true, but you should be getting something for it. And like any advisory relationship, price is what you pay, value is what you get, right? Don't necessarily get hung up on the dollar amount of fee you're paying. So long as you feel you're getting enough value for that dollar amount, that's fine. If and when you feel like, I don't know that I'm getting $5,000, $10,000, $20,000 of value worth of this relationship every year, that's a different story. Then you have to reassess. But anyway, so you are getting something for the fees that will be getting pulled out of your IRA if and when you do the rollover to work with an advisor. Alrighty, moving on. So that's it for the pros. Let me get a quick drink here. And I'm back. Now the cons. This is probably one of the biggest ones. So when I say con of a rollover, this is sort of a reason why you'd want to leave it in your employer plan or not roll it over. There's something called the Rule of 55, which many of you have probably heard of. That says, generally speaking, if you have a tax-deferred account like a 401k, 403b, IRA, TSP, you generally cannot take the tax-deferred money out prior to age 59 and a half without having to pay a 10% penalty. You'll always have to pay tax when you take out tax-deferred money, but if you take it out before 59 and a half, there's typically also a 10% penalty. There are some exceptions. We've done videos on that before. I won't get into them now, but let's assume one of those exceptions don't apply. You're basically stuck. So if you were to roll all your money to an IRA, there's a big caveat to this, but if you roll all your money to an IRA, generally speaking, you can't easily touch it before age 59 and a half without paying a 10% penalty. Most employer plans, 401ks and 403bs, allow something called the Rule of 55. That's not a specific technical name. It's just generically called Rule of 55. It says that if you have a separation from service from that employer in the year you turn 55 or later, oftentimes you'll be allowed to take money out of that plan and that plan only without the 10% penalty. So let's back that up. Again, if you're working somewhere, you have a 401k there, let's say, or 403b, you have a separation of service in the year you turn 55 or later. Now, separation of service could be voluntary departure, retirement, you get fired, you get laid off. If you have a separation of service in the year you turn 55 or later or older, many plans waive the 10% extra penalty if you take money out from that point forward. So do the math. That happens when you're 55 at the youngest, up until 59 and a half, when that 10% penalty goes away anyway. There's potentially 4.5 years of benefit here to leaving your money in your employer plan if you can access it penalty-free prior to 59 and a half by way of Rule 55. There's also something called the Rule 50. Now, this applies to, I forget the specifics, but like 403b plans. There's some, I forget the exact term, like higher risk public safety jobs, like federal firefighters, federal law enforcement officers, things like that. They can access penalty-free starting at 50. If they have a separation of service from 50 or older, the 10% penalty goes away. But outside of that, it's 55. The other big exception is a 457 plan. Most, if not all, 457s don't have the 10% penalty to start with. Regardless when you stop working, what age, your money will be taxed when you take it out of the 457, but I don't think there's a 10% penalty in 457s to begin with. So anyway, so if you're retiring younger than 59 and a half, and most or all of your savings is in your 401k, for example, and you leave in the year you're 55 or older, you may want to leave some or all of your money in your 401 if you're going to need to access it prior to 59 and a half, so you can avoid the 10% penalty. Now, the big caveat I said before, even in IRAs, there are ways to get at the money prior to 59 and a half without paying the 10% penalty. It's called Rule 72T distributions, which also means SEPP, series, substantially equal periodic payments is what it stands for. Long story short is, regardless what age you are, you can get approval from the IRS to set up a payment plan whereby you will take a certain amount out of your IRA every year for at least 5 years or until you turn 59 and a half, whichever is longer. And so long as you stick to that payment plan, they'll waive the 10% penalty. But that plan's really inflexible. If for whatever reason you need to take less or take more or stop taking it, not good. If and when you break the terms of that plan, they will retroactively then reassess the 10% penalty on all the money you've thus far taken out. So generally speaking, avoid those 72T plans, or otherwise known as substantially equal periodic payment plans, unless it's kind of a last resort because they're so inflexible. You don't want to get stuck in a bad spot where, for whatever reason, you have to start taking more, taking less, or whatever. Anyway, so avoid that if you can. But point is, all hope is not lost. If you're in an IRA and you're younger than 59 and a half, there are ways to get at your money without the 10% penalty. Just, there's pros and cons to it. Next, the next con of doing a rollover is inability to delay RMDs if you're still employed. And what do I mean by this? So many employers, again, depending on the employer, will waive having to take required minimum distributions from that plan if you're still employed there. So for example, you love your job, you're 71 this year, you're still working, you still have a 401k there. Flip the calendar, it's next year, you turn 72 this year. In all of your IRAs you may have outside your employer, you're going to need to start RMDs that year. And other 401ks you have from previous employers, you're going to have to start RMDs in the year you're 72. But for the plan whose employer you're still employed at, so long as you're still working there, you do not have to start your RMDs until you eventually leave. The one big exception is you can't be more than a 5% owner in the company. And there may be some limit on employee size, like either 20 or 100. I don't remember. I could be off on that. But for the most part, if you're at a large employer, you're not more than a 5% owner, there's a good chance you can delay RMDs from that plan if you're still working. If and when you roll that money out, well, guess what? You lost the ability to delay those RMDs because, as I mentioned before, IRAs, RMDs have to start at 72. Doesn't matter if you're still working. They don't care. RMDs have to start. So anyway, you give up the ability to delay if and when you roll it out. Now, a lot of cases, that's not a huge deal or benefit for people, but nonetheless, it's something to be aware of. The next con of doing a rollover, and this is something I mentioned before, and this is what I said before, where the one investment you probably don't have access to in the outside world that you do in your employer plan is a quote unquote stable value fund. So what is this? It's basically a high yield savings account where the interest they'll credit you is, depending on the plan, 2.5%, maybe, give or take. There's some that are getting around 3% from what I hear. Some are less, but figure 2.5% is probably about the average, is my guess. And again, it's like a savings account that there's no loss of value. You put in $1,000 into it, you're going to get your $1,000 back plus whatever guaranteed stated interest they say. These don't exist in the outside world, or at least not in the form and shape they exist within many large employer plans like 401ks. And the thrift savings plan has a stable value like fund called the G fund. It basically invests in government bonds and pays a guaranteed rate of interest with no risk of loss of principal. So that's functionally a stable value fund. The nice thing is you can put money in and take money out. Some employers may limit you to only doing it once per quarter or something like that. You may not be able to duck in, duck out every day, but still, it's a good tool there. Risk-free, it's going to get you higher than market interest rate. Like I said, 2 to 3% is probably the going rate in most of them. These don't exist in the retail world. You simply don't have access to a stable value fund. Now, there are things sort of like it, but that have multi-year guarantees you have to commit yourself to. I'm thinking of something called the multi-year guaranteed annuity, MYGA. They look and act like a certificate of deposit, but they're technically an insurance contract issued by an insurer. You say, I'm putting in $10,000. I agree to leave it there for 3 years. In 3 years, you give me back my $10,000 plus 2.5% per year interest on it. That's the closest you can get to a stable value fund, but there's minimal liquidity. Once your money's in, it's kind of locked up for that 3-year, 5-year, 7-year contract, whatever you selected. You can dribble out a little bit each year, but you can't freely come and go with it, whereas you typically can, or you can come and go much more freely in a stable value fund. So that's something you give up if you roll all your money out of your employer plan. Once you leave your employer and take the money out, most plans, if not all, won't let you then put money back in. So something to consider. The stable value fund you can sort of use as like your cash buffer, your cash cushion. Now, the downside is if your 401k is all traditional tax deferred, you may not want to have all of your emergency fund there, right? Because if and when you need to pull money from it, you're going to have to pay tax on it. And you may not want that tax hit. So I wouldn't recommend people just plowing all of their, if you use a bucket system or your first few years of spending, a couple, $300,000-$400,000 cash, I wouldn't necessarily say keep it all in stable value because, again, you're going to be taxed when you take it out. So that's the downside you have to keep in mind with that, assuming your employer plan is tax deferred. Anyway, so that's something you probably give up if you have access to one in the first place, is a stable value fund. The other con, where am I at? This is the last big con I came up with, and I say in italics, potentially less creditor protection. So this one's confusing, and honestly, I don't even have the exact answer. I've read different things from different reputable looking sources about this. So employer retirement plans like 401k are covered by what's called ERISA, E-R-I-S-A. It stands for the Employee Retirement Income Security Act. It's this big sweeping Employee Retirement Plan Protection Act put in place in 1974, I believe. As part of ERISA, all plans under it, like 401ks, have cannot be touched. If you're the plan participant, you're the employee, and you have $2 million in your 401k, and you go bankrupt, the bankruptcy court cannot come after your 401k. Important. Also, general creditor protection. Someone slips and falls on your property, sues you for $5 million. They can't come after your 401k because it's protected by ERISA. Whether it's $1 or $5 million in that 401k, people can't get at it. Now that's ERISA. 403bs, many, if not all, I'm not an expert in the 403b space, but a lot of them are not part of ERISA and don't have that same unlimited protection, I don't believe, again, because they're not part of ERISA, or most of them aren't. 457s, I'm not sure. TSP, I think has the same protection, but I don't know for sure. 401ks definitely do. IRAs do not have the same level of protection. Now here, okay, let me step back. If you open an IRA and contribute to it yourself, there is some amount of bankruptcy protection. As of this year, it's like $1.3 million or $1.4 million. So based on IRA you contribute into, your contributions and growth, everything up to $1.3 million or $1.4 million is protected from bankruptcy just the same, as ERISA protection is. That's at the federal level. As general creditor protection, this is where things get weird. Slip and fall protection, that's in IRAs, that's all determined state by state level. Now, most states do have not necessarily unlimited, but pretty good amounts of general creditor protection on your IRAs. So you're still protected in almost all states to some extent. So you're not giving up completely all coverage by having things in an IRA. Now, here's the other rub, and this is where I've gotten conflicting answers from reputable sources. Remember, all the money under ERISA plans, like a 401k, unlimited bankruptcy, and general creditor protection. IRAs that you open and contribute to yourself have $1.3 million or $1.4 million of bankruptcy protection, and state by state, different amounts of general creditor protection. What if you roll your $5 million 401k into your IRA that already has, let's say, $1 million from your own contributions and growth? What happens? From what I've read, and this seems to be the consensus and the right answer, but again, I'm not making any guarantees. Check with lawyers, check with whoever. This is what I believe to be true. The $5 million that you roll out of your ERISA protected plan keeps its unlimited protection with it. Even when you dump it into your IRA, you don't lose the unlimited protection on that $5 million. So then the $1.3 million or $1.4 million limit that you have on your IRA just applies to your own other, your contributions and the growth thereon. You're not losing protection on what was in your employer retirement plan. So assuming that's accurate, this completely debunks the potential concern to worry about giving up any sort of bankruptcy or creditor protection by doing a rollover, because, like I said, what I believe to be true, but don't quote me as because I'm saying I'm not 100% certain on this, all the money that was in your 401 maintains its unlimited protection even when you roll it into an IRA. So again, it may be worth looking into yourself or asking lawyer friends or whatever, but I because of that, I don't think the protection issue is one to be concerned about in most cases. But again, do your own diligence and confirm that for yourselves. Alrighty, so that's the, is that it? I think that's it. That is, yeah, end of slideshow. That's it for the pros and cons of employer plan to IRA rollovers. Now, let me bring this back up, stop sharing my screen. Now, that's not necessarily comprehensive. I'm sure there's probably other things I'm missing. Those are the big ones. I'm confident saying I caught the big ones. Now, yes, there could be some other smaller, nuancy things I didn't catch in that. I'm just trying to think. Like, there's one federal specific I came across. I forget the exact nature of it, but something along the lines of, if you're a federal employee, when you leave, you have an option of taking a lump sum or a traditional, pension stream for your pension. The health benefits, retiree health benefits, are tied to having the pension. So if you don't elect to take the pension, I think you forego the ability to get the retiree healthcare benefit. I could be wrong, but I think that's the case. You forego the opportunity to get the federal retiree healthcare benefits if and when you take the lump sum. So in that sense, taking a lump sum from your federal retirement and rolling it into an IRA, you may be giving up the ability to get the federal retiree health plan healthcare benefits. I could be wrong. I think that's the case. If anyone here knows, feel free to correct me. But that's another possible con of doing a rollover is, specific to federal employees. By not taking the pension option, I think you're giving up something or potentially giving something up. Okay, so I'll leave it there. That's it. Let me now take another drink here and check the questions. I guess I'll start at the top and scroll down, see if that's a decent way to do it. Okay. Interesting. In Maryland, you can get some state tax benefits by leaving some money in a 401k pension versus IRA. Interesting. Did not know that. Okay. That could definitely matter then if you live in Maryland or will be retiring to Maryland. Good to know. Thank you, whoever this was. Let's see. I don't know if anyone responded to these. Is it best to liquidate old 401k before rolling over or transfer in like kind and then move to new investments? So this all depends. Some 401ks will force you, well, the only option will be they'll liquidate the entirety of your account and then send the cash proceeds over to wherever you're rolling it to. In many cases, their only way of rolling it is to send you a paper check with the account proceeds on it for you then to take and deposit into your IRA. If you have, some will do electronic, like I did a rollover from Vanguard to Fidelity. Vanguard had to liquidate everything within the 401k, but they were able to electronically move the money to Fidelity. There's no paper check process. If your 401k and IRA are at the same custodian, then they can quite possibly do it in kind. They can simply take whatever securities in your 401k, just swing them over to your IRA, done, clean and simple. And then you're free to then sell them, reinvest them, whatever you choose, or just simply keep them if you like those investments. Let them sit in your IRA. So it's not, whoever posted this, it all depends. You're kind of limited by what your 401k will allow. Many times they will force you to liquidate, and then you have to, move the cash and reinvest, or potentially you can move things in kind, security for security. What is this? I have a traditional IRA over 100,000, all funded with after-tax money except 5,000 of it. I'm retiring this year. Should I convert the current traditional to Roth, then roll over 401k to IRA next year to convert to Roth over the next few years? I'm not yet 59 and a half. Do I need to look into this? Okay. I can't answer that. Whoever this is, some very specific questions that, I can never say in a public forum with 2 sentences of info what you should or shouldn't do. But yes, everything you're mentioning is an option. As far as what's best, I'm simply not in a position to say. Especially should you look into 72T, that's a whole can of worms to try to give any sort of meaningful recommendation or guidance on that. I appreciate the question, but a little too specific to give any sort of comments to. Thank you, though. What is this? If you did fee-only advisor, would you still have the 401k issue? Yes. So fee only doesn't mean, fee only means that the advisor does not have any securities brokerage licenses or insurance licenses. So fee only simply means they can't sell you products for commission. Okay. Fee only does not mean, what am I trying to say? I'm thinking of double negatives. So someone can deduct fees from assets and be fee only. Someone could do hourly fees and be fee only. Someone could do fixed annual fees like I do that aren't tied to asset size, and I'm still fee only. So a very large part of the advisors who do charge by, the typical 1% of assets under management, they are fee only actually. Again, fee only just means they have no licenses to sell you things for commissions. It means they get paid only from you. Their fee comes only from you, the client. And what form that fee takes doesn't necessarily matter. Could be billed out of assets, could be paid by credit card, could be paid by check. Those are all fee only. So no, fee only advisor would quite possibly and likely still have the 401k issue. I'm taking the traditional, percent of AUM, percent of asset advisor. Large portion of those are fee onlys, and they will have this hang up. Yeah. Brenda asks, why do you have to take RMDs from Roth 401ks? I don't know. Ask the IRS. That's a good one. My guess is when you take money out of a 401k, Brenda, most, if not every case, you can't cherry pick. If you have a Roth 401k and a traditional 401k, the same employer, you can't, most, if not all times, you can't say, take me out just 5,000 from the tax deferred, leave the Roth. And then next week, take me out 1,000 from the Roth, don't touch the tax deferred. With 401ks, it's, even though you have a sort of Roth internal bucket and a tax deferred internal bucket, they're all collectively one big account. When you take money out, the money comes out in prorated slices out of your Roth money, your tax deferred money. Therefore, when you turn 72 and need to start taking RMDs, I don't think many, if any, 401ks would let you take money just out of your traditional tax deferred and not touch your Roth, because again, I think money all comes out in a prorated slice. So that's probably the answer, Brenda. If you can actually bifurcate and take money out of your separate 401k accounts, then it's a different story. Then I don't know why you have to take RMDs from Roth 401k, but I suspect it's because of what I said about the prorated distributions. Oh yeah, here's a good one. When I rolled out my 401ks to IRAs, why didn't they move the residuals out too? Now I'm getting a check. Grr. Yeah, this happened to me too a handful of jobs ago. So I had a 401k at a large bank / brokerage I worked at, and I left to moved to another employer. So I rolled out my old 401k into my new employer's 401k, and it was a pretty substantial amount. And then I rolled it out before the end of year dividends hit. So the end of year capital gain distributions and dividends. So I rolled it out. I'm just gonna say December 10th. I'm making this up. So my 401k balance was zero at my old employer. Well, guess what? Like a week later, a few $1,000 showed up from whatever, dividends or capital gains or something. Now, I didn't even know it was there. I got a letter like months later from Fidelity saying, hey, by the way, you have an IRA. We're going to distribute to you. Oh, no, they didn't say distribute. They said, we open up an IRA for you. I was like, what? I never opened an IRA at Fidelity. It ends up what happened was that leftover money, the residuals, if it's under a certain amount, I forget the specifics. If it's under $500 maybe, or maybe 1,000, they can just cash you out. They're just going to send it to you. You have to pay tax on it. It's not cool, but that's within their right to do that. Because when your amount's so small, it's, the IRS cuts from the break and like, yeah, you don't have to pay the record keeping administrative expenses for $500. Just give the person back the money. So you can just liquidate it out that way. If it's over, I think $500, but under, I forget, 5,000, I'm making this up, I could be wrong, then they can just dump it into an IRA for you. When you sign up in the 401k in the first place, I guess it's baked in that agreement that it says, if and when you leave, if there's a certain amount of money left, we will open an IRA for you. You give your consent when you sign that form without even knowing it, probably. That's what happened in my case, I think. So anyway, so I had this like $1,800 IRA or something at Fidelity. from the leftover residuals of my 401. I just simply then rolled that IRA over into my new 401. No harm, no foul. But yes, it was kind of annoying. It wasn't something I thought about until it happened to me a handful of years ago. But that's the deal there. Grr. Alan Thomas, what is the SIPC insurance limit for an IRA? I believe it's the same as regular brokerages, because an IRA is just a brokerage, all said and done. It's a brokerage account with certain tax treatment. That's all that's really different about an IRA. So Sipc stands for Securities Investors Protection Corporation. Just like banks have FDIC, Federal Deposit Insurance Corporation. It's a federal backstop of insurance against banks going under. Sipc is the same for brokerages going under. Completely drawn a blank on what the Sipc insurance amount is for normal brokerages, but I suspect whatever it is for normal brokerages, Alan, it's going to be the same for IRAs, because again, IRA is just a normal brokerage, but with what's different is how the money's taxed. So good question. If anyone else knows, Cody, I feel like this is your spot here. Not putting you on the spot. I'm just saying I feel like this is something Cody knows, because he's a freak like that. So maybe he already responded to it and I missed it. Can you comment on differential treatment of 401ks versus IRA tax by different state? Not entirely sure of the question. I guess, June, you mean, do states tax 401k distributions versus IRA distributions differently? The answer is I don't know. There's 50 states. They're all free to have their own different tax legislations and structures. So it's possible they tax things differently. I don't know. What I can tell you is on the way in, things are slightly different. Like in New Jersey, for example, where I live, New Jersey does give you a state tax deduction for contributions to 401k, but they do not give you a state tax deduction for contributions to any other employer plan. So if you're a teacher, I have teacher friends at 403Bs, they get a federal deduction for making 403B contributions, but they do not get a New Jersey deduction for making 403B contributions. Whereas me, when I worked in private industry, I did, because I had 401ks. That's the difference there. And I don't think New Jersey gives IRA deductions either. It's just 401ks. Gotta love New Jersey. Okay, what else do we have? How are 403Bs distributed? Questions, RMD questions. So it all depends what you choose, and it depends how the plan is set up. Some 403Bs are kind of like 401ks. They're invested in mutual funds. When you eventually retire, you can let the money sit there and take it out. Again, the employer may have some restrictions, like you can only take out a withdrawal once a quarter or a handful of withdrawals per year or whatever. Maybe they'll let you have free access to it, whenever you want and however much you want, but you have to check with your employer. So that you can do that, or many 403Bs, because again, they are ultimately annuities. There will be variable annuities where it looks like an investment on the surface, but it's really an annuity. If and when you choose to annuitize it and turn that investment into a lifetime payment stream, that does the distributions for you, right? You basically turn your investment into a pension-like product. It's going to throw you out however many dollars per month for the rest of your life. That's how you get distributions from it. So it all depends. And yes, there are RMDs in 403Bs. In the year you turn 72, you have to start taking money out from your 403B accounts. Good question. Ooh, I see OJ Simpson. ERISA protected OJ Simpson's defined benefit plan of over $4 million. Yep, unlimited. Even if you stab and kill your wife and her husband, your money in your 401k is protected from Judge Ito. I didn't know that, Cody. Thanks for sharing that. Alan, TSP, Thrift Savings Plan, is protected from creditors. Good. Thank you for clarifying that. What else do we have? Skipped over it. Mavis, Andy, my understanding is that ERISA protection for the 401k to IRA rollover varies by state. Quite possible. Thanks for sharing that, Mavis. Now here's what I don't know. So that could very well be true. There's different protections to keep in mind. There's bankruptcy protection. I'm not a lawyer, so this is just my sort of dumbed down understanding. This is how I picture it in my head. There's bankruptcy protection and there's general creditor protection. So what's bankruptcy protection? That's where you get into debt over your eyeballs. you're insolvent, you owe more than you own, that's bankruptcy. You say, I can't pay my bills anymore. You know, the court, you go to bankruptcy court, they'll work out some of your debt, maybe whatever, get them reduced and put you on a plan, things like that. That's bankruptcy. That's not general creditor protection. General creditor protection is the slip and fall stuff. You know, so I forget to shovel my driveway in the winter, someone slips, breaks their neck, sues me. That's general creditor protection. You have to distinguish. So, like I said, federally, IRAs have bankruptcy protection up to this amount, changes each year. It's like 1.3 or 1.4 million this year of bankruptcy protection in IRAs. The creditor protection, yes, that definitely varies state by state in IRAs. So now the question is, and this is what I don't know, and maybe you do know, and this is part of what you're sharing, Mavis. Under ERISA, you have unlimited bankruptcy and creditor protection while the money's in ERISA. If and when you roll that out, maybe it's from what you're saying, it's I don't know if you mean that just the creditor protection now is dictated by the states, or if the bankruptcy protection is also dictated by the states. My guess is the bankruptcy protection may still stay, because in IRAs, bankruptcy protection is determined federally to start with. It might just be the creditor protection that might possibly change based on the state. Mavis, good point. Don't know the answer, but thank you for bringing that up. That's another angle to consider. This poster moved nearly all of his or her TSP into a brokerage IRA, and I'm so happy that it happened. TSP was extremely limited in terms of flexibility to invest and withdraw. Yeah, I looked at this one point. I don't remember the specifics, but yes, there are limitations on how much or how frequently you can take money out of the thrift savings plan, whereas with the IRA, there are no such things. Now, one of the cool benefits of a TSP is they will let you put money back in. I think it's maybe $200 is all you have to keep. When Casey Madsen was on talking about federal retirement planning a handful of months ago, this was a cool trick he mentioned. So like the G fund and the TSP, like I said, that's basically a stable value fund, guaranteed interest, won't lose money. It's a nice little tool to take advantage of if you have it, to perhaps keep some of your cash in just to get some better than zero interest. And the TSP will let you put money in after you leave, from what I'm told. Now, again, there's restrictions and limitations on being able to take it back out. So maybe the juice isn't worth the squeeze with this one, but still something to keep in mind. Yep, rolling over TSP would seem to provide withdrawal flexibility, definitely. For lump sum versus pension, can I choose to take only part of it as lump sum and the rest as a pension? That depends on your plan. Whoever posted this, if it's a federal plan or if it's a municipal plan or private pension, you have to check. In theory, yes, but it's possible that it's all or none. I don't know. Maybe this person was responding to that. Perhaps, I'm not sure. What do we got here? IRA with a mix of rolled in 403B, inherited 403B, inherited spouse, and non-deductible contributions seems like a hard mix to parse out for takes. No. Let me think about this. So yes and no. So no. So once the money's in there, Marjorie Beebe, once the money's in there, it shouldn't matter because it's all going to get commingled. So let's assume your 403B was all traditional tax-deferred money. And let's assume the account you inherited from your spouse and made your own. I assume that's what you mean by that. You put it into your own IRA. Let's assume that was all tax-deferred money as well, just to keep the example simple. And you made some of your own contributions on a non-deductible basis into the IRA. So what happens is your 403B, that's all tax deferred, that's all simply now tax deferred in your IRA, as is the inherited IRA you rolled in from your spouse. That's all simply tax deferred as well. Your contributions that are non-deductible, that were non-deductible, they stay after tax. They don't lose their classification. Any growth you've made on that is tax deferred. So that tax deferred growth and the money you rolled in, that's all just one big happy tax deferred pot of money. It doesn't matter where it came in, what type of plan it was in before. Inside your IRA now, it's either tax deferred or it's quote unquote basis, which is after tax. That's it. You know, there's only two things it can be. So no, it doesn't make it that much more difficult. When you do take money out, you will need to fill out Form 8606 on your tax return every year. That's what tracks the amount of your non-deductible contributions versus everything else. So you know when you take money out, that does a calculation of proration of how much is taxable and how much is a tax-free return of your original contribution. So good question, but no, don't let those things stop you. Now, the reason why I hesitated was you said inherited spouse. So generally speaking, when someone inherits an IRA from someone else, you can't make it your own. You have to leave it where it is. And that inherited IRA will have its own RMD calculation, perhaps, separate and distinct from your own IRAs. The big exception is if you inherit it from your spouse. In that case, you can simply roll it into your own, pretend like it's always been your own. It gets folded in the mix just the same. It loses its inherited status. Inherited means nothing at that point. But anyway, if you're inheriting from anyone other than a spouse, you can't put it into your own account. So then it does sort of complicate things a tad. Not sure what you're laughing at, but I like it. Thank you. Another con to moving is if you don't otherwise have IRAs and only able to do backdoor Roth, you lose. That's the one I wanted to mention. Yes, thank you. You only do. Let me start over. Another con to moving is if you didn't otherwise have IRAs and only able to do backdoor Roth, you lose the ability to do it because of the Perata Rule. I learned the hard way. Not really a question, but wish I had heard of this group before I rolled. Yeah, thank you. Crap. Yeah, that was the one I missed today. So the slides I put together, I stole from a video I did months ago about pros and cons. I just looked at the scripts from that and I made my table off of it. And I knew after I did the video months ago, I realized there was a big one I forgot, which was Perata Rule. And I meant to put it in tonight. I remembered this morning, but I forgot when I actually sat down to do the slide. So thank you. So what does this mean? When you do conversions from a traditional IRA to a Roth IRA, you can't pick and choose to convert just after-tax money versus just pre-tax. All of your IRA, all the money in all your IRAs get mixed together such that any dollar you take out or convert is deemed prorated slices of however much pre-tax money you have and however much after-tax. So let's assume you only have $5,000 of after-tax money and $1 million of pre-tax money. You can't convert just that $5,000 of after-tax money. When you do a conversion, it's going to be 99.95% taxable because it's assuming the conversion is coming predominantly from that tax-deferred money. There's a trick to get around the Perata Rule is if you have a 401k, you can move all the money out of your IRAs into your 401k. If your 401k allows you to roll IRAs in, many do, most do, then your IRAs are now empty so that you can do an after-tax contribution. There'll be nothing else in any of your IRAs except that after-tax money. You can immediately convert it to a Roth and there will be no tax on the conversion because all that money will have already been taxed. That's the other benefit to having and or keeping money in a 401k is if you're going to be doing Roth conversions and you want to avoid the Perata Rule, this will be a big con to doing a rollover. So thank you for whoever this was. Sloppy on my part. I definitely should have added that. Great ad. Can you roll over only TSP Roth 401k? I knew the answer to this. I think so. I've rolled over a couple TSPs, but we rolled over everything, tax deferred and Roth. And I know they did come as two separate checks, obviously. I feel like either Casey Madsen or Brad Bob, he's my other federal benefits, federal go-to guy. I feel like one of them may have said at some point, yes, you can choose to roll out just the Roth from TSP. I could be wrong, but I think that is a possibility, June. Whereas with the 401k, I don't think it's possible. You have to do prorated rolls and distributions. What's this? With regards to creditor protection for 401ks versus IRAs, once you start to take the money out of either account type, the protection goes away. That's a good question. I don't. So Dave Fultz, I guess the question is, let's assume it's a regular IRA. You have $1.3 million of protection, let's say, and you coincidentally have exactly $1.3 million of balance. Are you asking, like, if you take out 100 grand, you should still be covered, I would assume. Yeah, actually, I don't know how. So if you have more than the coverage amount, I don't know what the coverage applies to. If it's always $1.3 million, or if like it's prorated with your distributions, that's a good question. Now, for many people, I don't say it doesn't matter. Like, I don't say legal protection doesn't matter. I'd be ignorant to say, but unless you're in a very litigious career, like doctor, lawyer, or if you have a bunch of rentals, or otherwise you're at high risk of personal lawsuit, I wouldn't let the creditor or bankruptcy protection thing be a big driver in your decision making. It's definitely something to be aware of, again. But in many cases, just simply having some good umbrella insurance for a few $100 a year is really cheap protection. That's good to have anyway for most people. Again, outside of doctors, lawyers that have separate, malpractice and other high lawsuit likelihood. For the average person, just get some good umbrella insurance. I don't think you need to get too hung up about all this protection stuff with your retirement accounts and IRAs. I don't want to say it doesn't matter again. That'd be silly to say, but anyway, don't let it drive your decision making. Yeah, Cody, here we go. Thanks. So SIPC provides up to $500,000 coverage per customer held at a specific institution, not per account. But they treat your Roth and traditionals as separately insured if you have. Okay, good to know. Thank you, Cody. Helpful as always. What is the benefit best use of a stable value fund? Good question. Simply just guaranteed interest. That's the benefit. So like now, high yield savings account, you're going to get 0.5% interest, maybe 0.6 somewhere, right? Those you can put your money in, take it out whenever. 0.5% interest. That's the going rate. If you're willing and able to lock it up for a few years, then you start thinking about MYGAs, multi-year guaranteed annuities, where you can get 2 to maybe 3%, depending on the insurer, and also depending on the length of term. The longer the contract you lock yourself in for, the higher the rate will be. So you can get relatively high interest there, but the downside is lack of liquidity, right? It's a multi-year contract. You can only take out like 10% per year at most. Above and beyond that, there will be surrender penalties that will eat into your principal. So if you want a guaranteed 2 to 3% return, Alan, you got nowhere else to go, right? Savings accounts aren't going to get you there. Multi-year guaranteed annuities can, but with multi-year commitments, stable value funds are the only other option that will get you 2 to 3%, with still some liquidity, maybe not daily liquidity, but the ability to take it out probably at least once a quarter. That's the benefit. Guaranteed interest, relative liquidity. The downside is, like I said, many people, most their money in their employer plans is in traditional tax deferred accounts. So any money you park in your stable value fund there is going to be, all the interest that it gains will eventually all be ordinary income tax when you take it out. And if you're using the stable value as your emergency fund, it may not be the best idea, because if some big expense gets sprung on you and you have to pull 50 grand out, it may not be cool to pull 50 grand out of your 401k and have to pay tax on all that when, like I said, because you were parking all your cash there just to get the stable value interest. The downside is, it's all taxable when you take it out. So I'm not saying it's right for everyone to use their stable value as their cash bucket, but knowing that interest rates are just so low everywhere else, to squeak out an extra 1.5%, 2% interest by taking advantage of a stable value fund isn't a horrible idea. Worth looking into, Alan. I'm not saying it's the end all be all, but something to consider. And TSP has the G fund, which is functionally a stable value fund. All right, looks like 2 more questions. Let me go to this. So Alan, it looks like, thank you. It looks like you're posting something on behalf of a Katrina. I don't see this in the list. I don't know why. And I know sometime last week, someone else was repeatedly posting a question. I wasn't able to see it. So thanks to someone else last week who copy and pasted the person's question, just like Alan did here. So Katrina asks, CARES Act withdrawal and rollover, how does that affect taxation in the next few years and possibly into retirement? Was this a bad move to move it into an IRA account? So I assume, Katrina, you were asking about the ability under the CARES Act to take up to $100,000 distribution from your tax deferred account, whether it was an IRA or 401k or 403b. The benefit of this special CARES Act provision was no 10% early withdrawal penalty. So even if you're only 40 years old, you can take out $100,000 from your 401k, for example, without the penalty. And the other kicker, the other benefit is, instead of it all being taxable this year, or 2020, I should say, the CARES Act allows you to spread that tax evenly over 3 years. So 2020, 2021, 2022. That's the benefit. That's what's special about the CARES Act thing that I assume you're referencing, Katrina. So how does that affect taxation the next few years? Well, it depends how you opted to be taxed on it. If you chose to pay tax on the full thing in 2020, then you would have had a really big tax bill last year, and it's not going to impact the next few years. If you chose to spread it out over the 3 years, then that's your answer. You're going to have a fairly chunky additional amount of taxable income for last year, this year, and next year. Into retirement, it shouldn't matter unless you're retiring like soon. But the CARES Act thing is only a 3-year tax payment deferral at most, so this isn't going to stretch indefinitely, Katrina. Plus, you can also put it back if you want to. That's the other benefit of the CARES Act distribution, specifically called coronavirus-related distribution, or CRD. The IRS gives you the ability to put it back. Like if you took all $100,000 last summer, and you're like, oops, I don't really need this all, they'll let you put it back. So you can undo some of it. If you already took some out, paid tax, I guess you'd have to amend your return if you want to put that part back. But the parts you didn't pay tax on, you can still return back and have it not be taxable. So was it a bad move? Impossible to answer. It all depends why you did it, what the benefit was, what the downfall was or is or could be. I can't say. For those who needed access to the money, right? That was the purpose of this thing. People lost their jobs, people were sick, people whatever, they needed money, and maybe their only source of funds were their 401ks or IRAs. So the IRS wanted to be kind of nice and say, okay, fine, you can take it out. We'll waive the 10% penalty. You're still gonna have to pay tax, but we'll give you 3 years to pay the tax as opposed to all this year. So that was the reason behind it. That was the rationale, the spirit of why they did it was to help people. So I don't know whether or not it was bad or good for you, Katrina, but good question. And looks like this is the last question. If you have a traditional IRA and rollover IRA and TSP 401k, do you prorate based on the sum of these accounts when you do Roth conversions? No. So the TSP, June, and this is what the other person was mentioning that I forgot to add as a con to the rollovers. You only have to prorate across your IRAs. So whether it's a traditional IRA, a SEP IRA, a simple IRA, all those things get aggregated and prorated. Employer plans do not. 401ks do not. TSPs do not. 403bs do not. 457 do not. It's just IRAs. So if you have, if you wanted to do Roth conversions, for example, and you wanted to avoid or minimize proration within your IRAs, you can attempt to move a good chunk of your IRA into your TSP if your TSP will allow you to do that, or if the TSP will allow you to do that, thereby having only a small amount, if any, of IRA money left. But no, employer plans that are not IRAs do not aggregate with IRAs when it comes to the Perata Rule for doing conversions. Good question. Okay, I believe that is it. Just taking a look here. I don't see any other questions. Nope. Okay. Alan just responding back to Cody. Cool. All right. I will leave it there. Next week, what do we have next week? This should be good too. How to decide between taking a pension or a lump sum. That's always a crowd favorite. And that's another one where there's not going to be a right answer. It all depends on you and your circumstances and your risk tolerance and your legacy goals, and whether or not you have a spouse and what your collective plans and goals are together. So that'll be a good one as well. So don't forget to join me next week. And I plan on doing, once the Biden tax plan is proposed, I do plan on doing a video on that. I don't know if I will bump out one of these regular Wednesday night things that's already in the schedule, or if I'll just add it in on like a Tuesday night or something. But I think that'll be worth mentioning if and when the Biden plan does sort of get a little more crystallized. There's been lots of rumblings, even since the campaign, things he said he wanted to try to do, but that's still so, until it's actually, memorialized and here is my plan of what I want to try to do, I think it's a little too premature to talk about the stuff in detail. But once that plan is out there, and maybe some happened today. I know Biden was presenting his infrastructure plan. Along with that's going to have to be the tax plan, how to pay for it. So I don't know how many details were discussed yet, but when there is some more tangible guidance given from Biden and or Congress about potential tax changes and increases, I will be sure to do something on that, because they will be fairly substantial, fairly impactful. Given the balance of power in the government, this is their shot. The next 2 years, up until the next midterm elections in 2022, this is the party in power. This is their chance to do something big. So I suspect something big will happen in the next 2 years. As we get more color, I will be sure to discuss it all with you and share my thoughts in a video. All right, that's it. Thank you all for joining. I will see you next week. Take care.